So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a guillotine, but I am here to stay. Won't look away. The storm is coming, so you better start running. No, you can't control, feel it in my bones. I'm coming for the, coming for the. I'm coming for the throne. For the throne. So you wanna be my enemy? You should've known I'd never kiss the rain. Ice runs in my veins, won't play it safe. I don't belong with your nobility. Who died and made you king of anything? You think that I'm insane? It's your mistake. Kingdoms rise and fall. I've come to take it all. I'll take it. I've come to take it. Kingdoms rise and fall. I've come to take it all. So you better start running. No, you can't control, feel it in my bones. I'm coming for the, coming for the. I'm coming for the throne. For the throne.
Let's go. Yo, I'm like an addict, ooh, I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it. Fuse like a magnet, lose, won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. Rising the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Cause damn, I was built to last. You move slow and I move fast, and that's facts. Only I can make a change. Slowly take a step today. I will never be the same. Cause that's what it takes. I take shots to the top, I'll get it. I got one life, I'ma do all to win it. I do slow when I move fast, and that's facts. Only I can make a change, slowly take a step today. I will never be the same, 'cause that's what it takes.
All right, guys, good morning. What is today? Thursday, February 26th. We have the Marcus Corp Q4 and fiscal year 2025 earnings call about to start in 6 minutes. Let's go through the press release real quick, just in case you're not familiar with this. This is a smaller Northeast U.S. exhibitor. Premium formats, and they also own hotels up in the Milwaukee area, if I'm not mistaken. So kind of an interesting play because you got two pieces of the business to make money in or worry about, depending on your perspective. You can see on the chart here, this is a ticker that I trade fairly regularly. I bought it back in 2024 at $11 and change, made about 100% gain in 5 months, exited the trade as box office was peaking, and waited, like we often do, a long time, almost a year, to rebuy. I didn't quite get the bottom. I think the bottom on this stock was around $12.90. I got in at $13.95. So I am up in the trade, and you can see this green line. I have a $24 price target for the next 12 months. I think we will easily revisit the previous highs, maybe even exceed them with the expected box office that we have for the remainder of this year, starting in Q2. So exciting stuff. Let's put up the, I do have the old Marcus Corp dashboard. You can see there's a lot of green on here. It's a relatively safe play. This dashboard does not tell you what a proper entry is. It's just, if you want to get in my brain and see, like, when I say something is risky or safe, this gives you a quick visual. And I have been working for the past couple days. If you wonder where I've been, where are the AMC and IMAX videos? I've been working on updating the dashboard to something I think is going to be a lot better for me to convey information and a lot better for you to see how the other side, if you will, is looking at any trade as they are analyzing risk. It's going to look something like this. I've been tweaking and working on this updated report card. Here we have Cinemark to give you a view with a little more detail about profitability, liquidity, financial efficiency and growth, valuation. Is it properly valued, overvalued, undervalued? And a couple of other things that I look at. And just as a benchmark for all of these buckets, I have the Altman Z score here at the top. And then I assign it a weighted score depending on how these things, how they stack up. And this is very objective, right? All of these are numbers that come from company financials. This is not me swaying any sentiment or pushing any narrative. This is all information you can look up. So maybe some of y'all will find this useful. Maybe some of y'all, I didn't ever think to look at that. Let me go learn about that. maybe one day, if you're interested, we can do a video or live stream walking through every section of the new report card, but not my intention to do that in every video, just to show it up on the screen and you get a quick green, yellow, red, and overall score. The AMC report card, IMAX report card, and Marcus Corp new report card all will be published in the next couple days. Again, a lot of people, as I was saying the other day, a lot of people can understand high reward in speculative plays. Not a lot of talk about what is the other side of that equation, which is risk. And if you want to know how I'm looking at plays to analyze, understand risk, and size my trade relative to that risk, well, this gives you an insight into the things that I'm looking at. I don't ever assume just because it's high reward that I should pile my entire fortunes into that one stock. You know what I mean? If we have something that's all green, those are the stocks that I want to own as the bulk of my portfolio. If we have something that's red and yellow, that doesn't mean I stay away from it. It means simply that I'm going to carefully manage my position size and my stop loss, or whatever I've identified to manage the risk, whether it's a mental stop loss or a hard stop loss. Marcus Corp was trading up in pre-market today as high as up 7%. It pulled back a little bit. We're up 4% on the day, $16.51. Not too shabby. Quick look at the results before the call starts, which will be momentarily. On the 3-month, fourth quarter, and year, the company grew revenues and had positive operating income. Huge swings from a year ago on Q4, and positive operating income in both segments. So you can make money in the entertainment industry. Some of it is timing related, but you gotta, I like some relatively safe plays where I know I can make 50 or 100%. I'm not. Did we lose the stream? There we are. I was saying, why not have some of my eggs in the basket of profitable company?
Marcus Corporation.
All right. The call is getting ready to get started. I'm going to shut up now, but we'll hang out in the chat.
Thank you, Drew. Good morning and welcome to our fiscal 2025 fourth quarter conference call. I need to begin by stating that we plan to make a number of forward-looking statements on our call today, which may be identified by our use of words such as believe, anticipate, expect, or other similar words. Our forward-looking statements are subject to certain risks and uncertainties, which may cause our actual results to differ materially from those expected or projected in our forward-looking statements. These statements are only made as of the date of this conference call, and we disclaim any obligation to publicly update such forward-looking statements to reflect subsequent events or circumstances. The risks and uncertainties which could impact our ability to achieve our expectations identified in our forward-looking statements are included under the headings Forward-Looking Statements in the press release we issued this morning announcing our fourth quarter results, and in the Risk Factors section of our annual report on Form 10-K, which you can access on the SEC's website. Additionally, we refer you to the disclosures and reconciliations we provided in today's earnings press release regarding the use of adjusted EBITDA, a non-GAAP financial measure, in evaluating our performance and its limitations, the copy of which is available on the Investor Relations page of our website at investors.marcuscorp.com. All right, with that behind us, this morning I'll start by spending a few minutes sharing the results from our fourth quarter and the full year and discuss our balance sheet, liquidity, and capital allocation. And then I'll turn the call over to Greg, who will focus his prepared remarks on where our businesses are today and what we see ahead for 2026. We'll then open up the call for questions. This morning, we reported a quarter of solid execution and results, with both divisions delivering year-over-year revenue and earnings growth and outperforming their industries. In theaters, a film slate that featured a favorable film mix coupled with strong per cap growth drove meaningfully improved market share. In hotels, our renovated properties were winning in their markets, attracting increased leisure demand at higher rates that drove our RevPAR outperformance, capping a record revenue and EBITDA year for the division. Turning to the numbers and starting with a few highlights from our consolidated results for the fourth quarter of fiscal 2025. We generated consolidated revenues of $193.5 million, a 2.8% increase compared to the fourth quarter last year, with revenue growth in both divisions. Our fourth quarter operating income of $1.7 million was negatively impacted by $5.2 million of non-cash impairment charges in the theater division, which are excluded from adjusted EBITDA. Excluding the charges, our fourth quarter operating income was $6.9 million, growing 5.2% compared to operating income of $6.6 million in the fourth quarter of fiscal 2024, excluding impairment charges and non-recurring expenses in the prior year. We delivered $26.8 million of consolidated adjusted EBITDA, a 3.6% increase over the prior year fourth quarter. There is one unusual item in the fourth quarter below operating income that impacted our net earnings and earnings per share that I'd like to highlight. Our fourth quarter and full year income tax benefit includes an approximately $7.6 million or 24 cents per share benefit from federal and state historic tax credits earned related to the completion of the Hilton Milwaukee renovation. The impact of the credits is excluded from our adjusted EBITDA operating results. For the full year of fiscal 2025, consolidated revenues increased just over 3% from the prior year, with revenue growth in both divisions. Consolidated operating income for the year was $17.1 million. Excluding the fourth quarter theaters impairment charges, full year operating income was $22.2 million compared to operating income of $25.9 million in fiscal 24, excluding impairments and non-recurring expenses in the prior year. Finally, adjusted EBITDA for the full year decreased 3.1% to $99.3 million. Turning to our segment results, I'll start with theaters. Our fourth quarter fiscal 2025 total revenue of $123.8 million increased 2.2% compared to the prior year fourth quarter. It is important to note the shift in our fiscal calendar favorably impacted our revenue and attendance comparisons over the prior year periods. Our fiscal year ended on December 31st this year compared to December 26th in fiscal 2024, resulting in 5 additional days in our fiscal fourth quarter during the busy week between the holidays compared to the prior year, while removing 4 days in late September when business is slower, and resulting in 1 net additional operating day for the quarter. The shift in our fiscal calendar and additional days between the holidays had a 6.8 percentage point favorable impact on admissions revenue growth and a 6.4 percentage point favorable impact on attendance growth compared with the prior year fourth quarter. Comparable theater admission revenue increased 6.1% over the fourth quarter of 2024, with a more favorable mix of family films that played well in our markets. On a calendar quarter basis in both periods, comparable theater admission revenues decreased 0.7%. Comparable theater attendance decreased 5.7% in the fourth quarter of fiscal 2025 compared with the prior year fiscal fourth quarter, while on a calendar quarter basis in both periods, comparable theater attendance decreased 12.1%. Average admission price increased 12.7% during the fourth quarter of fiscal 2025 compared to last year, and was positively impacted by strategic ticket price optimization actions implemented during peak demand periods, changes to promotions during the holiday periods, and a higher mix of 3D tickets. According to data received from ComScore and compiled by us to evaluate our fiscal 2025 fourth quarter results using our comparable fiscal weeks, U.S. box office receipts decreased 1.5% during our fiscal 2025 fourth quarter compared to U.S. box office receipts in the fourth quarter of 2024, indicating our theaters lead the industry, outperforming by approximately 7.6 percentage points. We believe our outperformance is primarily attributed to our strategic pricing actions, as well as a favorable film slate that featured multiple titles appealing to family audiences, a genre where our circuit typically performs well. Per capita concession food and beverage revenues increased by 7.2% during the fourth quarter of fiscal 2025 compared to last year's fourth quarter, which was driven by increases in incidence rate, higher merchandise sales, and concessions pricing changes. Our top 10 films in the quarter represented approximately 70% of the box office in the fourth quarter of fiscal 2025, compared to approximately 75% for the top 10 films in the fourth quarter last year, with the slightly less concentrated film slate resulting in less than 1 percentage point decrease in overall film cost as a percentage of admission revenues for the fourth quarter. For the full year, film cost as a percentage of admission revenues was flat compared to fiscal 2024. On the higher revenues, theater division adjusted EBITDA was $24.1 million, a just under 2 percentage point increase compared to the prior year quarter. Turning to our hotels and resorts division, the fourth quarter capped another record year for division revenue and adjusted EBITDA. Revenues before cost reimbursements were $60.4 million for the fourth quarter of fiscal 2025, a 5% increase compared to the prior year. The shift in our fiscal calendar and net one additional operating day in the quarter had an insignificant impact on the hotel division revenues and results. RevPAR for our own hotels grew 3.5% during the fourth quarter compared to the prior year, growing at 3 of our 7 owned hotels. The RevPAR increase was driven by a 1.2 percentage point decrease in our occupancy rate compared to the fourth quarter of fiscal 2024, with our average occupancy rate for our owned hotels at 60.2% during the fourth quarter of fiscal 2025. Average daily rates grew 5.6% during the fourth quarter compared to the prior year quarter, as our newly renovated hotels continue to attract demand and drive higher rates. Our properties continue to perform well against the industry as a whole. Based on data from STR, when comparing our RevPAR results to comparable upper upscale hotels throughout the U.S., the upper upscale segment experienced an increase in RevPAR of 0.8% during the fourth quarter compared to the fourth quarter of fiscal 2024, indicating that our hotels outperformed the industry by 2.7 percentage points. Comparable competitive hotels in our markets experienced a RevPAR decrease of 2% for the fourth quarter of fiscal 2025 compared to the fourth quarter of fiscal 2024, indicating that our hotels outperformed their competitive set by 5.5 percentage points. We believe our outperformance versus the competitive set is primarily due to strong demand for our renovated hotels, as well as a heavier mix of transient leisure demand at higher rates. Group demand remained generally steady during the fourth quarter of 2025, with group rooms representing 35% of our total room mix in the fourth quarter of fiscal 2025, compared to 36% of our room mix in the fourth quarter last year. Our group mix in the fourth quarter of 2024 benefited from group business related to the election, with our group mix in the fourth quarter of 2025 reverting to more typical levels. Finally, hotels' fourth quarter adjusted EBITDA was $7.3 million, an increase of 3.4% compared to the prior year quarter, driven primarily by higher revenues. Shifting to cash flow and the balance sheet, our cash flow from operations was $48.8 million in the fourth quarter of fiscal 2025, compared to $52.6 million in the prior year quarter, with the decrease in cash flow from operations due to unfavorable working capital changes related to the timing of payments relative to our fiscal year end. For the full year, cash flow from operations was $84.2 million, compared to just under $104 million in fiscal 2024, which was also impacted by unfavorable timing of working capital payments at the end of fiscal 2025, compared to favorable timing of working capital payments at the end of fiscal 24. Total capital expenditures during the fourth quarter of fiscal 2025 were $22.4 million compared to $25.4 million in the fourth quarter of fiscal 24, which was primarily comprised of Hilton Milwaukee renovation project payments and maintenance projects in both businesses. Total capital expenditures for fiscal 2025 were $83.2 million compared to $79.2 million in fiscal 2024. During the fourth quarter, we repurchased approximately 118,000 shares of our common stock for $1.8 million in cash. This brings our share repurchases for 2025 to just over 1.1 million shares for approximately $18 million in cash, or approximately 3.6% of our outstanding shares at the beginning of the year. Our cumulative buybacks since resuming share repurchases in the third quarter of 2024 are now over 1.8 million shares, or approximately 5.7% of our outstanding share count when we began, returning nearly $28 million in capital to shareholders. In total, over the last 2 years, we have returned over $45 million in capital to shareholders through share repurchases and dividends paid during fiscal 2024 and 2025. Our balance sheet remains well positioned as we head into 2026. We ended the fourth quarter with over $23 million in cash and over $230 million in total liquidity, with a debt-to-capitalization ratio of 26% and 1.5 times net leverage. As we look forward, I'd like to provide an overview of our current capital allocation priorities for 2026. While we will continue to invest in maintaining our portfolio of high-quality assets in both of our businesses, we expect a meaningful step down in capital expenditures in 2026 as we move past the heavy reinvestment cycle of the last few years in our hotel division. In fiscal 2026, we expect to continue to make maintenance and ROI investments in hotels, as well as investments in maintaining and enhancing the customer experience in theaters. For fiscal 2026, we expect total capital expenditures of $50 to $55 million based on our current portfolio of assets, with approximately $25 to $30 million in hotels and $20 to $25 million in theaters. The timing of our planned capital projects may impact our actual capital expenditures during fiscal 2026, and we will continue to provide updates as the year progresses. We expect this decrease in capital expenditures to result in a significant increase in free cash flow in 2026, which will be allocated to opportunistic growth investments and returning capital to shareholders. While we often don't control the timing or availability of deals, we continue to actively search for opportunities to deploy capital to grow our businesses, and we are disciplined in our approach. We remain committed to returning capital to shareholders. In fiscal 2025, we returned $27 million, or approximately 32% of our cash from operations, to shareholders through our quarterly dividend and share repurchases. We plan to grow the dividend over time and opportunistically repurchase shares when we generate cash in excess of our near-term ability to reinvest or deploy for strategic growth. With that, I will now turn the call over to Greg.
Thanks, Chad. Good morning, everyone. With Chad covering many of the details of the quarter, I'd like to start today by reflecting a bit on the year. As is often the case with our two divisions, the story of the year was a bit mixed. We delivered another record year in our hotel division while successfully executing on some very big projects that we expect to have long-term returns. In theaters, while the box office came up short of expectations for the year, audiences continue to come out and have strong demand for the theatrical experience when we have periods of steady product supply. Because of the hits-driven nature of the business, the difference between a decent year and what would have been considered a great success was essentially one or two films that didn't hit as expected. For our company specifically, our fourth quarter results were quite strong, with both businesses outperforming their industries. In theaters, a diverse film slate with family content that played well in our markets helped us achieve strong market share. In hotels, strong leisure demand, particularly at our recently renovated assets, helped us end the year on a high note. More importantly, we exit the year with good momentum, and as we look ahead to 2026, we are encouraged by the growth opportunities that we see ahead. I'll start today with our theater division. Chad went over the numbers for the quarter with you, including our strong per cap growth for both concessions, food and beverage, as well as average ticket price that drove our outperformance for the quarter. Overall, the fourth quarter film slate featured a diverse mix of films across genres that appealed to wide ranges of audiences that was particularly appealing to families, which played well in our Midwestern markets. We achieved above average market share for 7 of the top 10 films in the quarter, with particularly strong share from Wicked for Good, Zootopia 2, Avatar Fire and Ash, Black Phone 2, and The Housemaid. The second tier of films beyond the top 10 also made important contributions to the overall box office, with mid-sized films like Regretting You, One Battle After Another, Marty Supreme, and Song Sung Blue delivering compelling stories that audiences wanted to experience on the big screen, not sitting at home on their couch. The well-rounded holiday slate offered something for everyone, and it is a great example of when our industry is at its best. While we had great blockbuster films like Avatar and Wicked that drew big crowds, the box office was so much more than the tentpoles. With multiple films working at once that appealed to different types of audiences. Our market share was also strong with several movies in the second tier of films, including double our normal market share for the Milwaukee-based hometown favorite story, Song Sung Blue. While the overall industry box office was softer than anticipated, we continue to believe this is largely a function of product supply and individual film performance. October was impacted by softer carryover from September releases than we saw last year, as well as a few titles that didn't hit as we hoped. The November slate had one less tentpole film over the Thanksgiving holiday compared to 2024, when the box office included Wicked, Moana 2, and Gladiator 2. When we had a more robust film slate in December, we again saw audiences come out as we would expect. This dynamic continues to illustrate the importance of maintaining consistent and steady product supply that is balanced throughout the year to support the momentum of moviegoing. As Chad discussed, we saw strong per capita growth during the quarter, with average ticket prices benefiting from our ongoing price optimization efforts. As we've discussed throughout 2025, this has been an evolving effort to strike the right balance between capturing price during peak demand periods, as we did during the busy holiday periods in the fourth quarter, and maximizing attendance by having various price points for different types of customers. In addition to optimizing price, we are focused on other opportunities to grow per capita sales, and during the quarter we made progress testing several initiatives that we will believe will be drivers of per cap growth in 2026. First, during the fourth quarter, we began rolling out a new queuing line system that consolidates multiple concession lines into a single line that then is served by multiple concession attendants. The single line moves faster, improving customer perception, and the queue is lined with merchandise displays that enhance product visibilities and are proving effective at increasing per capita candy and merchandise sales. We deployed the new queuing process and displays at 14 test locations in the fourth quarter, and we anticipate continuing to roll these out to additional locations in the first half of this year. Second, we continue to focus on improving the customer experience by looking at every step in the customer journey. For a significant majority of our customers, their first interaction with us is the digital ticket purchase. And while we've offered web and mobile app-based ticketing for many years, we saw an opportunity to improve this purchase experience. We've completely redesigned our digital ticketing experience to make the purchasing experience as easy, fast, and frictionless as possible. In November, we launched a new digital ticketing experience for mobile web browsers and our mobile app, followed by the launch of an entirely newly designed MarcusTheatres.com website in early February. The new site simplifies finding the movie, theater, and show times that work for customers, while speeding up the process of seat selection and payments. We're very encouraged by the early feedback from customers, and we are well positioned for the ramp-up in business as we head into spring and summer movie season. Third, we are working on improving the digital ordering experience for our best-in-class menu of expanded food and beverage options. Again, the goal here is simple. We're going to make the ordering process as easy and frictionless as possible. We know from experience that when customers order concessions, food and beverage on our mobile app, they buy more as they are consistently presented with upsell and cross-sell offers. We're working to significantly improve our mobile web ordering experience for those customers who want a fast digital ordering experience but haven't yet downloaded our app. In December, we began testing NC QR code food and beverage ordering for delivery to seats at 2 of our dine-in movie tavern locations and expanded this test to 3 more locations in January. The QR code ordering is simple and fast, with integrated digital wallet payment options that significantly speed up the transaction process. The early results have shown encouraging growth in F&B per caps at these locations, and we are in the process of rolling out QR code ordering to all our 20 movie, tavern, and dine-in theaters. This will be followed by a redesigned food and beverage digital purchase experience in our mobile web and app for all locations later this year. For those customers who prefer the more traditional purchase experience at the box office, concession stand, and our bars and restaurants, we began rolling out new tap-to-pay terminals in the fourth quarter, and we expect to have the rollout complete at all points of sale by the end of the first quarter. We expect these investments in technology will not only make the purchasing process easier for our customers and enhance per caps, but we expect to gain additional data and insight into our customers and their preferences through the new payment technology we are integrating across our various sales channels. We expect to leverage these insights to better tailor our communications and marketing with more customized offers that highlight coming events of interest. We believe it's very important to have programs that promote and incentivize repeat moviegoing, and we've created several with this goal in mind, including Marcus Passports, Marcus Mystery Movie, and Marcus Movie Club. These programs can also have the added benefit of bringing customers out to see a broader range of small and mid-sized films, in addition to the blockbuster films, which we believe supports a healthier overall exhibition ecosystem. While these programs offer a lower ticket price in the short term, we believe they are important drivers of long-term future attendance. In November, we reached the one-year anniversary of Marcus Movie Club, our subscription program that offers monthly or annual memberships with several great benefits for customers, including a 20% food and beverage discount, access to additional companion tickets for $9.99, and waived digital ticketing convenience fees. After our first year of Movie Club, we added free Marcus Mystery Movies as a new benefit for members, and we continue to look for ways to drive membership and usage of the program. Approximately 38% of members have selected the annual membership, which we believe supports our long-term goal of driving repeat moviegoing. Marcus Movie Club is one of several programs that promote and incentivize repeat moviegoing, including Marcus Passports, Marcus Mystery Movie, and our loyalty program, Marcus Magical Movie Rewards, which now has 6.9 million members. As we look ahead, we are very excited by a 2026 movie slate that includes several potentially very strong titles, including Spider-Man Brand New Day, the Super Mario Galaxy movie, Moana, Jumanji 3, Toy Story 5, Minions and Monsters, The Odyssey, The Mandalorian and Grogu, Dune Messiah, I'll get that right, and Avengers Doomsday, just to name a few. There are many more great films coming, noted in today's earnings release. The current slate has a stronger mix of tentpole films, and the grossing potential of 2026 franchises is greater based on their historical predecessor box office performances. Looking even further ahead, the early look at the 2027 film slate also looks strong, with major franchises including Shrek 5, Star Wars Starfighter, Minecraft 2, Frozen 3, The Batman Part 2, Sonic the Hedgehog 4, Spider-Man Beyond the Spider-Verse, The Legend of Zelda, Avengers Secret Wars, and many more. We are excited about the momentum that is building in theaters and the film slate ahead in the coming years, and we remain very positive and optimistic about the long-term future for the industry and our theater business. Moving to our hotel and resorts division. You've seen the segment numbers, and Chad shared the highlights of our performance metrics for the quarter, including our outperformance to the comp sets and upper upscale hotels nationally. So I will focus my comments on the year overall and looking ahead. We're pleased to report that after another strong quarter to end the year, our hotels team delivered another record-breaking revenue and adjusted EBITDA year in fiscal 2025. This is quite the achievement, given that we are comparing against a record fiscal 2024 that benefited from the Republican National Convention and election-related business that did not recur in 2025. It's even more impressive considering that we also completed the largest hotel renovation project in our history at the Hilton Milwaukee, which disrupted operations and negatively impacted results with a significant number of rooms at the hotel out of service during the first half of the year. Even with the negative impact of the renovation, our RevPAR growth outperformed our competitive set for the year by 1.2 percentage points, and we really saw an inflection point once we completed the renovation, as we outperformed the competitive sets by over 5 percentage points in the second half of the year. The demand environment was mixed in 2025, with group demand generally remaining strong. particularly at our properties that play well to group business. Leisure demand was mixed across our portfolio in 2025 compared to last year, with some markets seeing softness while others were positive. Demand remains strongest at the upper end of the market, thus our upper upscale properties are performing well in an environment where consumers continue to gravitate toward premium experiences. The Hilton Milwaukee renovation wrapped up in the fourth quarter with the lobby and lounge, marking the end of a renovation that updated 554 guest rooms, ballrooms, meeting space, and public common spaces. It looks fantastic, and it is a convention center hotel that Milwaukee can be proud of. While we have made significant capital investments in our hotels over the last few years, we have also been disciplined with the returns required for these projects. Hilton Milwaukee is a good example of our approach, as we chose not to renovate the 175-room west wing of the hotel and remove the rooms from the Hilton system at the end of December. In mid-January, we reopened the west wing as the Mark Hotel, an independent select-service hotel connected to the Baird Center via Skywalk. The rebranding and repositioning to create a new hotel with a different type of product allows us to continue to operate with minimal capital investment. As Chad discussed, the heavy part of the capital investment cycle that we've been going through the last few years is now behind us. We are winning in our key markets with our newly renovated room product and meeting space, and we've been able to capitalize on that opportunity. As we look ahead to 2026, we're very excited to open our new 11-hole short golf course at the Grand Geneva, known as We Nip. We completed the construction and the growing phase of the course in the late season last year, and play will begin this spring. We believe the course will allow us to capitalize on a growing segment of golf with a great complementary option to our two existing 18-hole courses on the resort, the Brute and the Highlands. With customers looking for distinctive experiential destinations, this added amenity aligns with industry trends, and we expect the short course to enhance the overall appeal of the resort to both leisure customers and group customers looking to mix in another social activity with conferences, training events, and outings. As we look ahead, our outlook for 2026 remains positive with our expectations for low single-digit RevPAR growth, led by modest growth in group business and steady leisure and business travel. Group bookings remain healthy with our group room revenue bookings for fiscal 2026, or group pace in the year for the year, running approximately 3% ahead of where we were at this time last year. Looking a bit further out to 2027, group room pace is slightly behind where we were at this time last year for the next year out, although this far out, the timing of bookings can vary significantly. Banquet and catering pace for 2026 and 2027 is ahead of where we were at this time last year. Based on the current demand environment and our future bookings, our outlook for 2026 remains positive. We are excited about the opportunities for future growth in the hotels business, and I would like to congratulate Michael Evans and our hotels and resorts team for delivering a great and record year. I'd like to once again express my appreciation for our dedicated associates at the Marcus Corporation. Their outstanding work and commitment to serving our customers is responsible for our success, and we appreciate all that they do every day. They are our most important asset. So on behalf of our board of directors and our entire executive team, thank you to all of our associates. With that, at this time, Chad and I would be happy to open the call up for any questions you may have.
Thank you. If you would like to ask a question on today's call, please press star followed by 1 on your telephone keypad. And to withdraw your question, it's star followed by 2. We'll go to Eric Wold from Texas Capital Securities. Your line's open. Please proceed.
Thank you. Good morning, guys. I guess the first question on the theater segment, there was a lot of shifts in the pricing strategy last May. You started lapping some of the headwinds. It sounds like you kind of implemented a few more things in the holiday period. Maybe give us a sense of what we should expect throughout 2026, maybe in terms of cadence based on the programs currently in place, kind of what you'll come up against this May, and kind of how that should play out throughout the year.
Thanks, Eric. In terms of the cadence through the year, really it's going to be the anniversarying of our price changes that we made mid-year in 2025. I don't see big changes to our programs prospectively. Again, we're trying to be very thoughtful about customer sensitivity to price changes and we do want to continue to drive attendance. So it's really, I would say, through the first 2 quarters, the year-over-year benefit that we're going to see of the actions that really didn't start to show up until late June in 2025. And then as we look forward, it's really going to be more about driving per caps in that business on the F&B side, and that's where our focus is going to be.
Got it. And then on the hotel side, there was a comment in the quarter about seeing increased leisure demand and higher ADR as the renovations have come to fruition last year. Maybe give us a sense of kind of what you're seeing in terms of bookings on leisure versus your business travel group kind of in this year, and if you expect to see more of a shift back to leisure with that, especially given the comments you made around group pace in 27. I know it's early, but should we see more of a shift back to leisure in your mind? And if that is the case, kind of what do you see as the implications of that?
Yeah, so let me start with the very last part of your question on group pace. You may recall at the beginning of 25, we were seeing very significant increases in group pace early in the year, and then that flattened out a bit, and we ended the year with growth that was kind of mid-single digits, but we started the year much higher than that. And so we had a huge step up early in the year last year, which is, I think, in part why our pace for 26 is right at the moment low single digit, and because we had a big step up last year. And when you're looking as far out as 27, timing of when those events get booked really can vary from year to year, and so I wouldn't read too much into what we're seeing right now for 27. It's still pretty early. Group overall remains healthy, and as we've said a few times over the last few months, a few quarters, our renovated properties are winning really well with groups. What we have seen, at least in the fourth quarter, is we're also doing a really nice job, even in the slow season, capturing strong leisure demand. And we did that here in the fourth quarter around the weekends. Upper upscale continues to perform really well with the premium products performing better than the lower end of the market, and our properties play well to that type of customer. So I think it's going to be one where even in a flat overall demand environment in leisure, we can capture share nicely.
The good thing about our properties that we've talked about before is that they play in both group and leisure. That is the nature of our properties. I've called them special assets before, and if you look at them, they're located and they're designed. So if we see softening in one area, we can start to be more aggressive in another if we see a pool of demand there, and you see it play out year after year.
Got it. Helpful. Thank you both.
Our next question comes from Mike Hickey from StoneX. Your line's now open. Please go ahead.
Yeah, thank you. Hey, Greg, Chad, congrats, guys, on a great 4Q with outperform. Greg, your 26 setup here sounds very encouraging, both on the hotel side, just given the level of investment and pacing here on group. The theater side slate looks exceptional. It seems like it'll meet your demo really well. Do you see sort of a step up's a big word, but at least relative to your 25 growth on the top line, do you think you can exceed that? And how much leverage should we expect on sort of a mid-single digit type growth and free cash flow conversion? I've got a follow up. Thanks, guys.
Well, hope springs eternal. Hope springs eternal in the theater business. It certainly, as you said, on paper, it looks good. And it looks like it plays to our markets, and it looks, and we talked about, I think, this in 25 we didn't have one blockbuster over $500 million. That is a challenge, and it looks like the potential for these is better. It's an art form. We don't know how it's going to turn out, but we're prepared to capitalize and maximize, on whatever comes our way. And it's a top line and the bottom line. We're very focused on, as you know, our pricing strategies and making sure that our prices are market appropriate and that we're offering the right product to the right customer. We have a very significant PLF footprint. It's probably on a relative basis, we have the highest penetration of PLFs in the industry. So when those customers are there, we're going to be able to capture them. We've got lots of programs for the customers that don't want to spend as much. We've got our Tuesday program remains very robust. A big push for us this year is going to be our movie club as we continue to really. If you are in our theaters now, you'll be. If you don't join the club, you aren't paying attention. I mean, we're really working hard to build that base of business. It reminds me a lot of the hotel business where you sometimes fill a hotel with a base of customers to sort of shrink the size of your hotel. And I think others in the industry who've seen a significant buildup in membership on the theater side enjoy that benefit of a continued income stream. So we're very focused on that as well. And then on the hotel side, I think that we'll continue to see the benefits of all the investment we've made in these properties. They look so good, and so that's gonna and that line in Milwaukee as our convention center continues to perform better. That we opened a few years ago. That will dovetail nicely with the Hilton, and we should see good performance as long as the economy stays solid. We'll be in good shape. As you know, hotels are very GDP dependent.
Yeah, Mike, I think that the last part. The only thing I'd add on the film mix is I do think that the family slate that we see ahead for 26 should benefit a circuit like ours in the markets that we're in. In the summer of 25, we didn't really have a family animated film that hit, and we saw the power of that over the holidays with Zootopia. And as we look at the slate for the summer of 26, I do think that's a net positive for Marcus Theatres. In terms of contribution and leverage on the incremental revenue, historically the theater business contributes at around 50% on the contribution margin line historically to EBITDA, and with our step down in CapEx this year, I think our free cash flow conversion on that is going to be very strong.
Nice, very helpful. I guess on M&A, you said actively searching. I don't know if I've heard that from you before. Are you sort of a little bit more aggressive, I guess, now looking at M&A? And I guess specifically, maybe regardless of that, maybe some color there, because I wonder with the Warner Brother deal hanging here, Greg, if that sort of ices theater deals or not. And then on the hotel side, I'm not sure how active the market is, but I don't think it's been great. So just curious where you're focusing your attention. Do you see the biggest opportunity, whether it's theaters, hotels, or maybe another area that could be complementary to your overall business today?
That's a very good point. Yeah, you're right. Look at I'll sort of work the hotels. I think everybody knows the hotel transaction markets are pretty slow, just across the entire industry. And so, we have to, just because I think it goes back to this, cap rates got elevated as interest rates went up. But, people were doing well enough that there weren't forced sales. The economy is strong enough. So it basically gave people the ability to continue to, I wouldn't even say pretend and extend, because there's no pretending. I mean, the businesses are okay. But if you wrote a pro forma, so much of these pro formas, when you have these investors, not necessarily us, where we're not looking at it like this, but a lot of private equity investors with a 5-year hold, and they write a cap rate. And if cap rates are 100 or 200 basis points is higher, it messes up the returns pretty significantly. And so if they can wait, or at least, they're going to try and wait. So it's a waiting game. So that's really slowed up that market a fair amount. So we have to look for other ways to grow that business and other ways to drive some revenue there, which we do in adjacencies. And on the theater side, there's not a lot of transaction activity, and very, very little transaction activity that you're seeing. So we'll look at anything that would come our way if we think it makes sense. a big challenge a lot of these guys have are very expensive leases. And so, a lot of that needs to be figured out. But but then you bring up a very interesting point, which we talk about, which is, what other adjacencies can we have? We've worked through these huge capital investments that we've had to go through, and so now when we have free cash flow, we're looking, and someone will, you'll ask them, what are you going to do? Well, if we can find good investments, we'd like to make them. It's very tax efficient to not pay the capital out if we can keep it invested within the company for our investors. That can be a great return. And if we can't, then we will distribute cash as we've talked about, the levers we can pull, whether it's buying back stock or dividends.
Nice. Thanks, guys. Good luck.
Thanks, Mike.
Our next question comes from Drew Crum from B. Riley Securities. Your line's now open. Please proceed.
Okay, thanks. Hey, guys. Good morning. Wanted to ask about the occupancy rate. It was down year on year in 4Q. Was that election related in the year ago period? Was it the closing of the west wing of the Hilton Milwaukee, or was it something else? And would you anticipate that rebounding in 2026?
Hey, Drew. Yeah, I'd start with occupancy in the fourth quarter last year did get a benefit from a bunch of group business related to the election, and a number of visits that we had in Milwaukee in our key market, and so that definitely provided a tailwind last year. I do think in some of our markets this year there's clearly some softness, and so it is very much a mixed story that is market specific and at times even property specific, but it's not an obvious softening trend in our markets where we're at, and we're outperforming the softness generally because of the quality of the assets and the investments that we've made. So I think the way to think about it is we should look to outperform what our markets do, even if we see some of the softness.
Got it. Okay. Thanks, Chad. And then, Mike's last question focused on M&A. Given the opportunity to review the portfolio, in the past, you guys have made selective divestitures. Any updates there? Any comments you can give us in terms of how you're thinking about that? Thanks.
We're always looking at our assets, and we come at it from a very a strong real estate mentality, and these assets. One of the things that's important, as you saw in the last few years, is as the bubble came across of investment. We have to look and decide. Okay, is the investment going to be a good investment for us? And if we don't think the investment is the right investment for us, we can then divest ourselves of the asset, and that will happen occasionally. We don't have any major divestitures planned right this minute, but if something makes sense or the markets get very hot, we're always looking at that and saying, okay, what is the right long-term choice for these assets for our company?
Yeah, and Drew, we tend to immediately think about hotels in that context, but we own a lot of theater real estate, and portfolio management is an ongoing process that we're continuously looking at the performance of individual theater locations and highest and best use for the real estate, and so I would just suggest that store management will continue to be part of a potential source of making changes, and we could add some locations too, but in the past we have monetized non-core real estate in our theater business.
Yeah, we might take investment and change some of the uses on some of our theater sites, and we can make investments to do that too. Again, we view ourselves, one of our hidden assets is our real estate, and we've come at this for decades from a real estate perspective, and we may make investments on our properties and that would maximize the highest and best use of that real estate.
Yeah. Thanks, guys.
As a reminder, if you would like to ask a question on today's call, please press star followed by 1 on your telephone keypad. And to withdraw your question, it's star followed by 2. Our next question is from Patrick Schell from Barrington Research. Your line's now open. Please proceed.
Hi, thanks for taking the question. Just maybe another question around like capital allocation and M&A. Could you maybe sort of discuss some of the, I guess, differences in underwriting, or opportunities in like expansion, whether organic or M&A, and like maybe the differences in underwriting, just additional new builds versus I know you talked about the difficulty with some of the leases and potential M&A, but any sort of update on those competing priorities?
Yeah, Pat. I mean, we're in the theater business. The challenge on M&A, and we have looked at a number of things in the last year plus, and done a fair amount of work on different opportunities. And the challenge consistently has been the leases at some of these locations, and the number of locations in a theater circuit that work and don't work. When you look at a circuit overall, that mix of locations that don't work has made it very hard to get deals done if you're going to have to assume the lease. And so it really requires more of a ground game in looking and doing, onesie, twosie type deals where you're picking up individual theaters in that space. And that's really how we look at the underwriting is at a more granular level than in the past. New builds, we think about it. We think about attractive markets, but right now I think with the product supply challenges, it's just tough to get the math to work on new construction. And so we're going to keep looking at it, but at the moment it's not something I think you're going to see us do a lot of in the near term.
Okay, and then on concessions, you had mentioned the QR ordering as helping to increase incidence. I was wondering what other components of the per cap trends in the quarter, what else contributed to the per cap trends in the quarter, or if like between pricing or mix and things like that.
Yeah, so in the fourth quarter, the QR code ordering actually had a really small impact. I think that's more of a 2026 benefit. We were doing a handful of test locations late in the quarter, but at those test locations, we were really encouraged by what we're seeing, and I think that's going to be a meaningful piece of our per cap uplift for our dine-in theaters in the coming year. In the fourth quarter specifically, it was mostly incidence rate and capturing more customers. It was some of the queuing line benefits that Greg talked about, and getting the basket size to grow with customers that are going to the concession stand. We've seen some traction with that, which is really encouraging. And there was a little bit of price, but price wasn't really the primary component of what we saw in the fourth quarter. And I think there was some benefit, certainly in a holiday quarter, of people making events of going out to the movies and just generally spending more. And I think that's encouraging to see the health of the consumer that we saw or continue to see in the fourth quarter.
Okay, thank you.
Thank you. At this time, it appears there are no other questions. I'd like to turn the call back to Mr. Paris for any additional or closing comments.
Thanks, Drew. We would like to thank everybody for joining us today, and we look forward to talking to you once again in May when we release our first quarter 2026 results. Until then, thank you and have a great day.
That concludes today's call. You may disconnect your line at any time.
All right, let's get Mr. Marcus's photo off of here. That was Greg Marcus, most of that call, catching us up on their theater and hotel business. What do we say? Over 78 or so theaters in 18 states, something like that. And 17 or 18 hotels in half a dozen plus states that they own or manage. It's an interesting little trade, and more importantly, they're profitable. And I just want to point something out here on the chart, because there are, from time to time, a couple people that get mad at me. Tony, why are you out of the AMC play? I want you to notice how long I was out of the Marcus Corp play. I bought back in June of 2024, $11 and change. Sold in November 2024, around the same time that I sold AMC. I doubled my money in Marcus Corp. And then I waited a year to rebuy. I'm at 15 months now waiting to rebuy on AMC. Look, I will wait as long as I need to the point where I see a low on the chart that is comfortable for me on a risk to reward basis, and at a point where I think the box office and the company financials tell me that now's the time to get an entry. And we just haven't been there yet for me to take an entry on AMC. And I will be as patient as long as that takes, because what makes me more upset than missing the absolute bottom penny, what makes me more upset is buying and then watch something keep going down. So, let emotions go, utilize some restraint, wait for the chart to signal that it turned around. You can notice back in June, it reached a low of 921. I did not buy there. I did buy the next week when we had a confirmed turnaround in the price. But I gave up $2. That's okay. Okay to give up $2 because I still doubled my money in 5 months. It's not about getting the bottom dollar. You don't need to chase things down trying to catch a falling knife to say you got the bottom price, because you might not have got the bottom. Wait for the chart to tell you that it found the bottom with a conviction in a turnaround. Am I worried about missing some massive spike up? I am not. I let that go long ago, and I haven't missed any run-ups. I've made money in every run-up in GameStop and AMC since then. Wake up early, have some alerts set, pay attention to what's going on. You're not going to miss anything. But you might go into the red if you're not paying attention, not listening to the right people, not looking at the financials with no emotions. Anyhow, Q1 is going to be rough for everybody, all companies. Q2, I'm super excited about. Q3, Q4. It's going to be a good box office year once we all get through this very rough Q1. Marcus Corp, what did they say? Their outlook for 2026. They finished the renovations on their prime property in Milwaukee, which is right attached to the convention center. So the hotel revenue per patron should go up. CapEx should go down because those renovations are complete. This company is buying back shares, what you guys want. They're paying dividends, what you want, because they have free cash flow. They have so much cash coming in, they can't even allocate it to grow their business. And when they're in that situation, they return the value to shareholders. This is what you want. I think it's a stock worth considering. At least, buy a couple shares. Learn how to trade one that is actually profitable and expected to grow. I have a $24 price target on this stock over the next 12 months based on earnings and a normal PE ratio. No hocus pocus, no made up rainbows and unicorns, not talking about this goofy price to sales shit that people try and do on AMC. It's undervalued based on price to sales. No, it's properly valued based on negative earnings. Wake up. Wake up. If you have a defendable thesis, you can defend it on multiple valuation models. You don't need to fall back to the only one that looks good. And I'm picking on one of the AMC YouTubers. He knows he can't talk about free cash flow. He knows he can't talk about annual net income. He can't talk about PE ratio. He can't talk about earnings. He finds one valuation metric that looks positive. Oh, on a price to sales basis, AMC is undervalued. No, it is a low metric compared to competitors because the company's losing money and the price is being punished. It's really that simple. Really bad analysis going on out there in YouTube land on AMC. And it is unfortunate that these people portray themselves as some sort of multiple degree business expert when they can't run multiple models on a evaluation and explain things to you the right way. This is a very defendable thesis, Marcus Corp. You could run discounted cash flow. You could look at PE ratios. You can project earnings positive. And they're paying dividends and buying back shares. I mean, this is just a solid story. I'll have a recap video for you guys on now that the new report card, the new scorecard that I've been working on the past couple days, a lot of refining, applying it to different companies, seeing what I like, what could I do better, how can I better convey information to you guys in a meaningful way, meaningful and objective. That is finally done, I think. I'll put it out there for AMC, Cinemark, Marcus Corp, and IMAX. And of course, I welcome your inputs, questions, and comments on the new report card. It's always a work in progress, but we've had a very basic one that we've used for the past couple years, and now me, taking it to a new level. Because I have realized over the past year or two that there are certain things that I'm looking at in companies, like free cash flow, for example, which weren't adequately addressed in the old format report card. So this is my attempt to level up the quality of information I provide you guys, and hopefully the quality of education, help you make better decisions. At any rate, thank you guys for tuning in. Hopefully you got some value out of catching up on Marcus Corp. Let's check in on all of the cinema companies here real quick. AMC trading flat this morning at 116. I'm waiting on updates on the debt restructuring. What were the final terms? I am hearing that they're having a little bit of trouble selling the debt. I was expecting we'd get an 8K this week. If they truly are having trouble getting that debt sold, it might be a few days or a few weeks longer than I was originally anticipating. I thought we'd have something like the next day, and here it's been a couple days now. IMAX is up 14%, 41.72. Beautiful. Another green report card with IMAX. You'll see that on the update video this week. Marcus Corp up 3%. Cinemark up 3.5%. 26.93. And our final meme stock of the day, GameStop, slightly in the red at 24.02. Saw one of the GameStop promoters saying GameStop definitely hitting $25 today. Don't think so. Maybe tomorrow. We'll try again tomorrow. I am long GameStop shares and warrants at about $20. So let's see what happens. Guys, thank you for tuning in. We will see you on the next one. Probably a live stream tonight. Take care.
A rectangle down by the dip, gotta hold our ground. We've been waiting for so long, edges rain will soon be gone. A green candle up, a red candle down, by the dip, gotta hold our ground. Edges gains are dead and gone, but the shorts we're going on. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down. By the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down. By the dip, gotta hold our ground. Hedges gains are dead and gone. But the short, we're going long. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down. By the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down. By the dip, gotta hold our ground. Hedges gains are dead and gone. But the short, we're going long. If you doubt it, sit and stare. If you love it, buy a share. Green candle up and red candle down. By the dip, gotta hold our ground. Hedges gains are dead and gone. GameStop's rising, going strong. If you doubt it, sit and stare. If you love it, show you care. A green candle up, a red candle down. By the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down. By the dip, gotta hold our ground. Hedges gains are dead and gone. But the shorts, we're going long. A green candle up, a red candle down. By the dip, gotta hold our ground. We've been waiting for so long. Hedges rain will soon be gone. A green candle up, a red candle down. By the dip, gotta hold our ground. Hedges gains are dead and gone. But the short, we're going long. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down.